You are listening to Keystone's Stock Talk Show, episode 291.
If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at Keystocks and on Facebook, and keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold.
It's great to chat with you again this week. We are back from a busy and interesting week in California at the annual Roth conference. In our Your Stock Our Take segment, I will begin with a viewer question on Neo Performance Materials, Inc., symbol NEO on the TSX, an innovator and manufacturer of rare earth and rare metal-based functional materials, including magnetic powders, rare earth magnets, magnetic assemblies, specialty chemicals, metals, and alloys. In a tough environment, the company reported Q4 numbers that actually beat estimates, driving its stock price 16% higher in 2025. I will let you know if this growth in the share price can continue. Brennan answers a viewer question on Canada Goose Holdings, symbol GOOS on the TSX, the Canadian iconic designer, manufacturer, and retailer of performance luxury apparel for men, women, youth, children, and babies in Canada, the United States, Greater China, the rest of Asia, Pacific, Europe, the Middle East, and Africa, anywhere where you want to wear a parka. Famous for its goose down parkas, the stock has failed to truly take flight and is now trading below its 2017 IPO price. Brennan will let you know if it's an opportunity today. To close our show, Brett reviews Algoma Steel Group, symbol ASTL on the TSX and NASDAQ, which produces and sells steel products primarily in North America. In an uncertain trade war environment, the stock is down 35% year to date. Brett lets you know whether the drop is an opportunity or a sign of things to come. All right, let's get to the show. My co-host, Mr. Aaron Dunn, is traveling through Italy right now. Lucky him. But fortunately, I have the Killer Bees, Brett and Brennan, here to rescue the show. Let's get to it. How are you guys doing?
Doing well.
Doing good.
Have you recovered from our 3 to 4 days in California at the Roth conference? As you can hear my voice, I'm not sure if I fully recovered from that week. A lot of talking. I think I lost my voice over the weekend.
Yeah, I've basically recovered. My peeling on my forehead has stopped. I got so burnt the first day because all the meetings were outside. And it's just every single year I forget my 30 blocks on screen. So next year.
We bought some for the second day.
Yes.
And Brennan got lathered up like a greased up pig. But he looked wonderful. And it was definitely sunny there. It's a little chilly by the ocean by the nighttime, but it was a beautiful setting right on the water there. I think the takeaways there were we told almost everybody we met with we were Canadian. There was a lot of apologies, to be honest, a lot of a bewilderment, to be honest. And as opposed to the conference I was at about a month previous to that, a little more acknowledgement of, the effect that it could have potentially, the tariffs I'm talking about on Canada. I think it was more front of mind for Canadians a month ago. It has become a little more front of mind for people in the U.S. And there's a lot of, we're sorry. We usually say sorry ourselves, but they were saying we're sorry to us. We love Canadians was really what we got. Now, I mean, we are there. They are there to present well in front of us because they likely want to be in coverage for us. So we didn't think we'd get anything. I hate Canadians, given that.
I was waiting for it.
Yeah, given that the type of environment we're in there. But anyways, it was we found a lot of that. But as far as the general economic climate, just a lot of uncertainty, really, from some of the management teams. Some of the companies there will be completely unaffected, but others that are affected, they're just waiting on some CapEx spending, waiting on how the trade environment breaks down. So a lot of uncertainty there, some frustration for sure.
Yeah. Yeah, like one thing that I'd mention is like we were actually in the John Wayne Airport, and I handed one of the TSA agents my passport, and he looked at it, saw that I was Canadian, and he looked me in the eyes, and he was just like, "I'm so ashamed. What's happening?" So it's not like we were just hearing that from companies, necessarily. We were hearing it just from general Americans everywhere. Um, and then as well, this is kind of a funny point. I kept getting companies or Americans saying that, I'd introduce myself, and they'd be like, "You're from Pennsylvania." I don't know. Like, it must have happened 3 times.
Yeah.
But yeah, that's just kind of a funny tangent. I thought that, I've never gotten that before in my life. Then I would tell them that I'm from Saskatchewan, and they'd be like, "Where? Is that real?" But yeah,
I
thought
thought I
that was,
thought that border guard was saying that to you because they were sorry they saw where you lived, and they're sorry you're from Saskatoon, right?
he probably didn't
That's
even
what
know
I
where
thought was
Saskatoon
going
is.
on there. It's funny actually. At that same moment, someone was saying to me, because the airport is in Irvine, and my last name is it's Irvine, but it looks like Irvine. So they're saying to
Mhm.
me, and I said, "Yes, I own the town, and get out." So that was good.
Of course you
No, it
do.
was funny. It was,
Yeah.
we had a good trip. There's
Yep.
likely, potentially one or two recommendations that could come out of that conference as well, because we had some good sit downs, about 20 and plus meetings that we did there. Good to talk to some companies in coverage, get the outlook on where they are today, where they're going, and then some new management teams, some companies that we're close on recommending to clients that probably come down in sympathy with the overall market, but have limited exposure in this environment, and they could be some buys there. So we're looking
Yep.
always, and that's why we do these events, to sit down with the intellectual capital, the management teams behind the numbers, and see if we want to place our dollars and our clients' dollars behind these companies. Okay, well, we don't have Aaron this week. Thank God for that. I'm kidding. But we're going to, again, keep those questions coming into our Your Stock, Our Take. We're giving a mug away. It's a little drawn out. By the way, nice sweater there, Brett. I just realized you're wearing the new Keystone sweaters. We should maybe all wear those for the next episode, right? That should
Brett
be
was
good.
yelling at me
But
before we went live.
yeah, I forgot. We should definitely get the mug given away over the course of this week.
Yeah.
All right. Should we move just into the show? Because we don't have a poll question, but we'll have one for next week for sure. So I'm going to do a brief update here on Neo Performance Materials, symbol NEO on the TSX. Trades around $9.28, $388 million market cap. Pays a nice dividend, 4.25%. But what does Neo do? Neo, they are headquartered in Toronto, Ontario. They're an innovator and manufacturer of rare earth and rare metal-based functional materials, including magnetic powders, rare earth magnets, magnetic assemblies, specialty chemicals, metals, alloys that are critical to the performance of many everyday products and emerging technologies, which are essential inputs to high technology, high growth, and future-facing industries. Neo operates globally through 3 segments. It's MagnaQuench, chemicals and oxides, and rare metals segments. Neo has a global platform that includes manufacturing facilities located in China, Germany, Canada, Estonia, Thailand, and the United Kingdom, as well as one dedicated research and development center in Singapore. Let's look at how the stock has performed this year. Like we said, in a weak market, it's actually up 16%. Most of those gains came after it reported Q4 numbers that beat street estimates. We see here over the last 5 years, the share prices are up, but remain in half from where they are in the $20 range that it reached in 2021 and 2022. So let's take a quick look at those numbers, the Q4 numbers and 2024 annual numbers released last week. Q4 2024 revenue was 134.9 million compared to around 128.7 million in the same period last year. So decent growth there. Year over year basis, 2024 revenue was 475 million. That's down from 571 million. Operating income for Q4 was 12.4 million compared to a loss in the same period last year of 5.5 million. So strong improvement there. Year over year basis, operating income was 35.3 million compared to 11.2 million. So good growth there as well. Adjusted EBITDA for Q4 2024 was 20.9 million compared to 3.1 million. Excellent growth there on a year-over-year basis. Adjusted EBITDA was 64.4 million, almost double the 37.2 million in 2023. Let's take a quick look at the balance sheet here. NEO has cash on hand of 85.5 million and 68.8 million in gross debt, 2.8 million in bank advances on its balance sheet. So it is in a net cash position. During the year, they invested 80.2 million in capital expenditures, primarily composed of the construction of its emissions control catalyst facility and for the new construction of its new permanent magnet manufacturing facility in Europe. NEO is under a strategic review. This was announced on June 14th, 2024, so it's been going on for some time. They announced that it's formed a special committee of independent directors to lead a comprehensive strategic review process to consider opportunities to maximize shareholder value. The process may or may not lead to a sale of the company, new direction, or a sale of parts of the business. It remains ongoing at this point, and we point out that the company, and we'll note this, the company, there has been no strategic, or can be no strategic assurance that the strategic review, process will result in any transaction or other alternative, nor any assurance as to the outcome or the timing. Let's look at valuations right now. This is based on the actual results that were announced last year. EV to EBITDA is about 3.5. Based on the estimates for 2025, the EV to EBITDA is 3.9. You can see it comes up there. We're expecting, and the market is expecting, somewhat lower, but not significantly lower EBITDA on an adjusted basis in 2025. So the conclusion here is it is an interesting company. We've looked at it for years. Valuations appear intriguing, but there's a lack of consistent growth and profitability. We can see here, this is the company's revenue and gross profit performance over the past 6 years. You see consistent inconsistency here in terms of growth and margin profile. Revenue is a high of 866 million in 2022, a low of 441 million in 2021, and today 684 million in 2024, with similar fluctuations as we can see in growth profit. Now, the annual and quarterly volatility leads to low multiples on the stock, and it's very difficult to forecast quarterly numbers with any degree of certainty. This is why the stock receives that low multiple and has led to likely the company's position in the market and its strategic review today. It can't get a significant market or multiple, off its EBITDA. If we summarize the Q4 results here, adjusted EBITDA of 20.7 million exceeded the $11 million street consensus considerably. As you can see there, when you see a company exceed by that amount, it kind of tells you that it's difficult to forecast the earnings on this company or adjusted earnings. It's driven by higher gross margins on hafnium inventory and Magnequench process efficiency. The stronger Q4 results pushed full year adjusted EBITDA to 64.4 million. As we said, that was above the $52 to $55 million guidance range. However, adjusted EPS was a loss of 12 cents, and it missed the 6-cent profit consensus due to the higher finance costs and income tax expense, with elevated tax rates expected to continue given the geographic mix of profitability. The continued earnings unpredictability remains a negative. The stock trades at a discount to its peers, but the consensus is for both revenue and EBITDA to move slightly lower in 2025. It has potential, NEO does, as a takeover target, but we rarely buy just on that element alone. And with numbers expected to be slightly lower in 2025, we would just monitor the stock at present.
Yeah. I mean, this is a company we've followed for some time. And the one thing is we knew that, CapEx, the company was investing, and, there was just heightened risk as, do you want to be investing while a company is increasing its CapEx and having potentially additional, costs? So that is one thing. I know as well, like their net cash position was much more significant, when we had previously been looking at it in 2022. Is that correct? I
Yeah,
believe
and
so.
they've gone out and raised capital as well, and
Yeah.
so and they're adding it. It was internally generated cash flow in the past, and
Mhm.
there's going from um, going to a fully vertically integrated model is the plan
Yeah.
here. That's going to take years. There's additional risk. I could see a strategic, a private equity firm taking this company private, them getting their ducks in a row in terms of getting the full vertically integrated business potentially going, and then relisting at some point. Like
Yeah.
that's what if I had to make a prediction, I could see that. Whether or not it gets bought out at a significant premium, that remains to be seen. They could just as well have a rare earths move against them in the next quarter, have a weaker quarter. The stock could come off and it could be taken over at a premium to where it is, but it could go down 30% and get a 20% premium. So you could be below it as today. I think a vertically integrated model here would smooth out profitability in the business. It's just not there right now. And I think not a good public vehicle when you have such fluctuations in quarterly and annual results. Potentially, if they vertically integrate over time, it smooths out those numbers. The company is in a sector that I think the market could take a shine to. It's just the volatility and profitability is there. And if you could smooth that out through vertical integration, I think that would be a better public vehicle so people could dig their teeth into, uh, have more consistent earnings. I think that is likely the path here. Whether that happens or not remains to be seen. That's your risk right now if you're looking at it. It could happen. But that if I look at a playbook, am I going to look back at this company 10 years from now? I see it going private, coming public again. We'll see if that happens. We'll
In
make a
10 years, we'll
prediction
do a
on that
follow
then.
up. Yep.
Yes, we will. All right, we've beaten that dead horse. Let's get to a not so alive goose, really.
Yeah.
Canada Goose, a iconic name. It's funny. I remember about six and a half years ago, we were looking at Canada Goose and Aritzia and making a recommendation there, and we went with Aritzia. And if you look at the share prices over the past 6 years, we are very happy we went with Aritzia over Canada Goose. But that doesn't mean there can't be an opportunity today. Brennan's going to take a look at it.
Yeah. So Canada Goose Holdings, GOOS on the TSX, trading at a price of about $12.30, about a $557 million market cap. And they design, manufacture, and sell performance luxury apparel for men, women, youth, children, and babies internationally, as well as in Canada, of course. And it offers parkas, light weight down jackets, rainwear, windwear, apparel, fleece, footwear, accessories for fall, winter, and spring seasons. The company has 3 segments: direct to consumer, including sales to customers through direct retail stores and e-commerce; wholesale, selling to other retailers and international distributors; as well as other, including sales from the Paoli Confetti knitwear manufacturing business. I absolutely butchered that. And as of December 29th, 2024, the company had 74 owned stores. And surprisingly to me, the company manufactures all of their products in Canada. I actually didn't know that. So Canada Goose's IPO was in 2017 at a price of about $17 per share. But despite revenue and EPS growth since this time, the stock is trading back down below its IPO price and is down about 50% over the past 5 years and is down 80% from its high in 2022. Now, I came across these 2 Canada Goose ads over the weekend. They're on the right-hand side there for the company's rainwear and light outerwear, as the company is primarily known for its large down jackets. So I thought that it was interesting that the business is trying to market and become more known for its light wear products beyond its heavier parkas. On top of this, in 2021, the company launched its footwear product line, including both boots and shoes. And just in January of 2025, they launched their eyewear collection. So again, you can see the company is looking to increase product innovation to be less of a one-trick pony per se. And I want to show this extreme seasonality here by analyzing in the business, by analyzing the operating margin of the company. So you can see that Q3, which runs from October to December, is typically its strongest quarter, and Q1 is significantly weak, consistently running an operating loss. Now, this is one thing that really keeps us somewhat weary of Canada Goose, as if we look at the business like Aritzia, for example, the company has seasonality, but it is far less extreme, and the business continues to operate at a positive operating margin throughout the whole year, as compared to Canada Goose there. Now, looking at the most recent financial results for Q3 of 2025, which ended December 29th, 2024, revenue was about $608 million, a decrease of 0.3%, or on a constant currency basis, decreased by about 2.2%, which reflects the strength of the US dollar and the Chinese yuan relative to the Canadian dollar in the current quarter. Same-store sales in its direct-to-consumer business decreased 6%, which is not good to see, and wholesale revenue was down 8% as the company plans to focus on premium and store locations. Management noted that the weak results show macroeconomic pressures affecting consumer sentiment in North America and EMEA, as well as slower than expected recovery in China. Now, gross margin was up to 74.4% in the quarter due to favorable pricing, lower inventory provisioning, and higher proportion of direct-to-consumer revenue. Meanwhile, it was offset to some degree by continued execution of their outerwear strategy, as their down jackets are typically higher margin. So keep this in mind as the company looks to diversify away from their down jackets. And this is like an actual direct quote from their MD&A. They say, as our product mix evolves, our gross margin has been and may continue to be unfavorably impacted by a lower proportion of down-filled outerwear sales, currently our highest margin products. So keep an eye there. And net income was $139.7 million, an increase of about 7% from the same period last year. And basic earnings per share was $1.44 per share, up about 11% from $1.30. And this was further benefited by the decrease in the number of shares outstanding. Looking at the balance sheet, the company has $285.2 million in cash. Debt and leases were $831.1 million, providing a net debt position of about $546 million, or a trailing net debt to EBITDA multiple of about 1.8 times. But if we do exclude the leases, this would be a little bit closer to 0.7 times the trailing net debt to EBITDA multiple. Looking at the company's fiscal 2025 guidance, management reiterated their total revenue growth of low single-digit increase to a potential low single-digit decrease, but decreased their profitability guidance, with adjusted EBIT margin being flat to down 1% and its adjusted EPS growth to the low single-digit increase to flat, with the CFO citing on the conference call that this was due to increased marketing investments and revised DTC, or direct-to-consumer expectations, as the contributing factors. On a valuation basis, the company trades at about 16 times trailing earnings, about 5 times trailing cash flow, and about 9 times trailing enterprise value to EBITDA. And this compares to other retailers like Aritzia, which trades with a trailing PE of 45 times, and Nike, which trades at 22 times. I was trying to look up VF Corp, which owns Nike, North Face as well, but they ended up selling Supreme last year, so the results were a little messy, and they actually have a trailing 12-month net loss. So technically, it would be negative. So just looking here, at these comparisons, relatively speaking, Canada Goose is discounted, but it is no surprise given their weaker results, reduction in guidance, and of course, tariff concerns. So to conclude here, Canada Goose is a well-known brand internationally, but is quite seasonal due to its down jackets, which are its primary products. The company appears to be working to diversify away from its primary product of down jackets, introducing new product lines, which over time may hurt margins, as down jackets are its higher margin product. The company manufactures 100% of its products in Canada, so tariffs on Canadian goods would impact the business. And just to put it into perspective, in the last quarter, about 25% of their overall sales were coming from the US. So keep that in mind. Now, the Q3 2025 results were weaker, with same-store sales down 6%, although EPS was up. The balance sheet is healthy and the stock trades at a discount to retail peers, but like I was just saying, is expected given growth and tariff concerns. Now, personally, I would be a customer of Canada Goose's products if I can actually afford them, but would not look to invest in the business. It has a great brand name, but really it just comes down to other names which are more attractive in the space and, I would prefer to own. Plus, I will add their products are very expensive. And personally, if I was going to own a stock in the retail sector, I would not want to invest in a company which is selling such premium goods, especially in, an uncertain macroeconomic environment. Like I was looking on their website, and they're selling joggers or sweatpants essentially for like $600. Where realistically you can get a nice pair of Lulus for $70 or $80 along those lines. So very, very premium products. Again, not a bad business, great brand name, but I don't think that I would be investing at this time. And there's the conclusion or the disclosure.
Yeah, fashion is fickle, and when you tie your name to one brand, I mean, there are some companies that can successfully do it and keep a premium brand over time. If someone says you're out, that is what would worry me about a name like that. I think the products are high quality products.
Yep.
They're pricey as all hell. But yeah, like I that is what worries me. And one of the things about Aritzia, they don't just sell their own brand; they have a bunch of brands under that name that they can sell through. So you don't tie yourself to just Aritzia is in or out. They have brands under that name. I mean, it's one of the reasons why we have favored that company over Canada Goose. The growth is way better too.
And one thing that I'd like to say too on
profitability is better
on Aritzia, like looking at the valuation, somebody would be like, well, why the heck were you buying Aritzia at 45 times earnings? Well, it wasn't. We saw the multiple expand, quite drastically, because of the consistent growth. So, I don't recall exactly what it was trading at, when we initially recommended
it. About 18 times, in that range, growing way above that.
Exactly. And probably, maybe I'm going out on a limb there, but probably less volatile when it comes to if consumers are hurting in the world. I think that, they're probably going to want to go and buy some, lower priced clothes rather than going and spending, $1,500 on a parka, or again, $600 on a pair of sweatpants, which I could go to Amazon and go and buy some sweatpants for probably $30, which are going to serve its purpose. So yeah, I think that is like one concern is, those higher end products may be more impacted if, the economy does take a little bit of a downturn.
Yeah. And if you just look at adjusted EBITDA in terms of Aritzia was up 48% in the last quarter. Net income was up 71%. Adjusted net income up 57%. So just a completely different level of growth in the businesses on an earnings basis. So really different businesses. All right.
I was just going to say one more thing. They have a big exposure to China as well, which has been macroeconomically weak, and it's kind of that same.
Canada Goose. Yeah,
you have about a third of their sales for Canada Goose are from China, a bit over actually. So if you see that economic weakness, which you have in the last few years in China, it's really hurt their growth profile because it was really seen as that growing, and they have such a focus on luxury brands there that it made a natural sense. But since they've had economic weakness, now are you seeing that going to happen in North America regardless of the tariffs? Yes. Yeah. But you've seen the repeat for over half the revenue.
you have worries on tariffs, but you just have a general economic slowdown as a worry too for a high-end retailer for sure.
Yeah. One last thing too, not to put you on the spot, Ryan. Did you know that 100% of their manufacturing, Canada Goose, was in Canada? I honestly didn't know that.
Yes, I did.
You did know that? Yeah, I didn't know that. Wow.
Yeah. Well, because we looked at it years ago, right? So yeah, but we have looked at it. Yeah, it is interesting. You would think that they'd be sourcing it, but it's Canada Goose. So it's the
no wonder they're pricing
down,
their products so high. Anyways.
Yeah. Well, they can right now.
Yeah.
For sure. Okay, well, let's move on. Brett's going to look at and review Algoma Steel. Interesting time to look at a company that is producing and selling steel primarily in North America.
Algoma Steel Group Inc., symbol ASTL on the TSX as well as they trade on the NASDAQ, produces and sells steel products primarily in North America, about 60% US, the rest Canada. It provides flat sheet steel products, including temper rolling, cold rolled, hot rolled, pickled and oiled products, floor plate and cut to length products for the automotive industries, hollow structural product manufacturers, and light manufacturing and transportation industries. So the stock is down a massive 35% year to date, trading at 906 Canadian dollars, that is, and about a $950 million market cap. As well, I should mention the company offers a dividend yield of about 3.2%. They pay that they pay 5 cents US a quarter. So you do have some foreign exchange fluctuations there for your dividend yield as well. So Q4 2024 results. I'll do a quick run through for the later financials. It should actually be Q3, but calendar Q4, because they actually did have a shift in their fiscal year, and now it matches the normal calendar year, but their fiscal 2024 year was actually only 9 months. But we're going to go through their Q4 calendar results, which the revenue fell 4% to $590 million, operational loss of $125 million compared to $37 million loss, a net loss of $67 million compared to a net loss of $85 million, adjusted EBITDA loss of $60 million compared to a loss of $1 million. So overall negative results across the board. But despite those negative financial results, the company actually did have higher shipments by 6% of 549,000 tons versus 516,000 tons. So higher shipments, but that just really shows that the steel market as a whole has just been hit quite hard, to say the least, and the profitability of steel products has just diminished massively over the past year, and especially over the past few years. Looking at the balance sheet, Algoma Steel was actually in our profitable cash-rich 2023 report, but that is no longer the case. They're no longer cash-rich or even profitable for that matter in the last quarter. They are no longer cash-rich due to significant investments, and I'll get into that in a minute. Algoma, they're now in a net debt position of $390 million Canadian. This is a moderately strong balance sheet still for them having such significant investments made over the past few years. And they've previously actually been in a net debt position prior to the steel price boom in 2021. This will be a concern if we do see a very prolonged weakness in the steel industry. Then the debt and interest payments will start to really hurt them. But at this time, it's still actually quite a strong balance sheet considering how significant investments they've made over the past few years. But if we do see a weakness going forward, you would want to really watch their debt level to see where it is, because if they do continue that unprofitability, if we do see steel margins collapse further, you obviously want to pay attention to their debt level. But the big investment they've made over the past few years have been their electric arc furnaces. They've been investing into their funds into two state-of-the-art electric arc furnaces, or EAFs, with the first coming online April of this year after a few years of construction. So obviously, big build up to this. The arc furnaces have been part of the long-term strategy for the company, and the second arc furnace, the first being in April, will be coming on later this year. So two big movements later on this year, with steel production from arc furnaces being weighted towards the latter half this year, as they do need a bit of time to ramp up and get all that worked through. The company expects the processing of all its steel to be through their electric arc furnaces by the end of 2026. So it's a big transitionary period for the company over the next couple of years as well. The cumulative investments for the electric arc furnaces project so far has been $740 million, with project commitments of $880 million. Just to give you a size comparison, that's not much less than their entire market cap at this point in time. So massive investments for them over the past few years into these new furnaces. Steel prices, however, have been weakening throughout 2024. They have seen a slight rebound over the past few months, but it's still overall a very weak environment, to say the least. And this chart on the right side of the screen here doesn't even show the massive increase in steel prices we saw in 2021 and into 2022 before they came down. And that's really where that cash balance they had previously came from. Was that year was just phenomenal for them, to say the least. But let's move into the elephant in the room. The reason for the decline in the stock price: steel tariffs. For the 9-month period, that's the fiscal year in a sense, 60% of the shipments went to the US. So tariffs will directly impact the company, as well as the steel industry as a whole would be negatively impacted during a general economic downturn. Steel primarily used construction, capex, your steel plate for military ship usage, things like that. When you have an economic downturn, normally you're not putting significant capital expenditure into those projects. You'll see just generally less. You'll see weaker steel demand overall. And at the time of the recording, the US has a global 25% tariff on steel, and then had previously announced an additional 25% against Canada, but was quickly reversed. Thanks, Doug Ford. But that changed very quick, and we'll see if that changes by the time this is posted tomorrow or the time you're watching this video. Very likely to change. But general customer and general economic uncertainty and tariff uncertainty impacts customer demand as well, as businesses just don't want to commit that significant capex when one day it might cost 50% more than the next month might be removed. You just don't know. And it is hard to commit to hundreds of millions or potentially billion-dollar projects when you don't know these pricing dynamics. Uncertainty just in general hurts demand. Whether or not things don't change in the long run, uncertainty will hurt demand in the short term and midterm until there's that clear line of sight. And we just don't have that right now. The company has stated when its new electric furnaces cost structure come online, even with a 25% tariff, it'd be roughly EBITDA break even at the current prices, but obviously prices can change in the meantime, as the company will see a significant cost reduction as electric furnaces come online and the blast furnaces and coke ovens eventually are decommissioned over the next couple of years. On the bright side, Algoma Steel is Canada's only discrete steel plate producer, and the company has stated they intend to switch some production of hot rolled coil to plate, which currently is in more demand in Canada, and it would avoid that direct impact from tariffs. Canadian plate pricing was trading at a premium compared to hot rolled steel in the last quarter, and the company expects a production of plate to be an annual run rate of about 650,000 tons at this time. So we'll see how that shifts over the next year, whether or not they do shift production to avoid tariffs or if that premium does last. And that really depends on how the supply chain switch, but they were previously seeing that premium intact in Canada. So I would expect that going forward as well. But really see the exact dynamic play out will be actually just interesting to watch. So just to wrap this up, Algoma Steel highlights really the crux of any commodity-based company, anything that really depends on a commodity price. The company is really on the precipice of having lower production costs with those electric arc furnaces. And it's really the combination of this long-term strategy coming online. But the steel market just isn't agreeing with them. It's been weak. And now tariffs have further impacted the company's prospects. Now the company is trading at a price which it implies a negative outlook for the company. And that's honestly fair to say. So a contrarian investor might love this stock. So if you do see tariffs just being a 3-month thing or 6-month thing, and then it completely reverses and we have that clear view of sight, you might love this stock depending on how the dice really roll with tariffs. But over the next few months, it's just would be hard to commit any sort of investment money in a steel producer, just in general, regardless of production increasing, cost decreasing, like we are potentially seeing in Algoma, or we're forecasted to see it from management to cost decreases. So we'll just continue to monitor this stock for the time being. But it will be something really interesting to lock if we do see it continuously to be beaten down, then we do see some clear sky view of tariffs and economic certainty. If there is a sudden shift and the stock does remain beaten down, you might want to take a position, but we're just not in that position right now. And just disclosures, we don't own the stock.
Yeah, for sure. I mean, it is interesting. I mean, you can see what management is trying to do, bring the cost structure down. and then you have more profitability, better profit margin going forward. I mean, the strategy is sound. It's like Brett said, the market's not cooperating with them in the near term. There's a high degree of uncertainty. Now, if that normalizes and you get then it has to normalize. You have to have a normalized environment. That's the other thing too. If we have a weak environment, steel, not the greatest place to be when you have a weaker general economic environment. If you could get a low price, an environment that is picking up, and they've now gone through this CapEx cycle, that might be a time to look at it. There's never going to be consistent earnings and profitability, even on an annual basis, like going like this on a company like that. But there can be times you could look at a business like that. It would more be a longer term investment trade rather than a longer term investment that you could just make and watch it grow over a 5 to 10 year period. It's interesting, and we'll continue to monitor it. But right now, you flipped from net cash to net debt, and the environment is certainly uncertain. Doesn't mean there can't be an opportunity, though.
Yeah, and just on that, Mark, just to highlight that potential volatility, as we saw that COVID crash, steel prices were quite low, and then that's why they really benefited in that 21-22 period, because the steel prices were just, supply chain was completely destroyed effectively in that period. Steel prices just skyrocketed, demand just came roaring back. I'm not saying that will happen, and frankly, I don't think that's going to happen in this case, but that is your upside scenario with these types of stocks, is when you do see that shift in demand.
Yep. Excellent. Well, I think that is going to close out our show for this week. Keep your questions coming into our Your Stock, Our Take segment. If you are watching this right now on YouTube, smash that subscribe button, or you're consuming this wherever you view or listen to your podcasts, rate and review us. And as always, I wish you profitable investing. Thank you.
Thanks, everyone.
Thank you.